Good morning. It's Mike with Cross Country Mortgage, and it's time for your Monday morning mortgage update for the week of January the 6th. Happy 2025. I hope you all had a great holiday week. It's been a couple weeks since really a lot has happened in the market. I always try to give you insight, tools, tips, things that you can use when you're going out and buying, selling a house, helping your clients, just to give you an idea of what's going to happen on the mortgage side of the real estate market to help you make those better decisions and have those more impactful conversations. So, always review what happened last week and what we expect for the coming week. So, what happened last week? It was a second week in a row of a short week because of New Year's Eve and New Year's Day. And so the market really didn't do any trading until Thursday and Friday. That's when all the bond traders, everybody that meant something to mortgage rates and the mortgage industry were back in the office. Why bond traders? Because mortgage backed securities are traded in the bond market, not the stock market, not the Federal Reserve when they change the federal fund rate every few months. Mortgage backed securities impact mortgage rates directly on a daily basis. And bond traders trade in the bond market, and that impacts mortgage rates. So they were back Thursday, they were back Friday. The market was flat last week. Nothing happened, but some very impactful information came out last week that really hasn't been talked about that much. Manufacturing numbers came out, two of them, Chicago PMI and ISM, which is a national manufacturing report. Chicago basically is the Midwest report. And what these reports basically tell us, tell economists, is are businesses making stuff? Are they producing goods that we buy or use? And they're not. So, insightful numbers. Chicago PMI came out with a 36.9% number. Now, anything below 50, not percent, anything below 50 is contractionary. That means businesses aren't growing. They're not making enough for a growing economy. They are in a very conservative place as far as what they're producing. And the last time we saw this number, 36.9, was right in the middle of COVID. When you were home, when you weren't buying anything, when you weren't going outside, it was a very low number. And that's where we are now, 36.9. This is a very bad number for manufacturing. ISM came out on Friday, and that number was below 50. So what we're seeing is a contracting economy, not a growing economy, and a contracting economy. And this flies in the face of a GDP right now that's 3.2%, which is growing. It doesn't make any sense. And we are spending a massive amount of money in the government. The last time we've spent numbers in this range as a percent of our GDP was in wartime, and we're not making stuff. We're just buying services. So the word that I've talked about a number of times is stagflation. That's when we have inflation going up and a weakening economy. Typically, when the economy is weak, we see inflation go down, and we're not seeing that. And stagflation is a bad word. Nobody wants to hear it. Nobody's really talking about it. But these manufacturing numbers, are they the canary in the coal mine? I don't know. But obviously, we're going to be watching these numbers moving forward in 2025. Now, look, this is all on the current administration, and the new administration, maybe they have some different financial policies, could change this, could reverse the direction of this. But right now, not a great number to start out the new year. So what are we looking at this week? Three things. I always try to give you some insight. A lot of jobs week's coming out. Federal Reserve members are starting to talk. They've been on vacation for 2 weeks. And then the government's selling a massive amount of debt. So let's talk about jobs. First week of every month, jobs numbers come out. We look at wages, inflation, jobless claims. We look at unemployment rate. We look at new jobs added, new jobs not added. So the stronger the jobs numbers, the worse it is for mortgage rates. A stronger economy, we don't need rates to go down. If we see weak job numbers this week, then it's going to be good for mortgage rates. And the question is, are we at the bottom? Let's look at the chart here. I want to show you kind of what mortgage-backed securities look like. So you can see over the last few weeks, it's been fairly flat, a little bit of up and down at the end of the week. And this is a graph that shows the trading of mortgage-backed securities in the bond market. And when we see this graph go up, we see the green candlesticks, and these all represent 1 day of trading. That means mortgage rates are getting better. When we see the graph go down, which is really all of December numbers showed rates go up. Inflation was the big issue, and then it just flattened out over the last couple of weeks. So, are we at the bottom here? Are we going to see a weak jobs numbers coming out this week that maybe could reverse course with our mortgage rates? The second thing is Federal Reserve. So every year, 4 Federal Reserve members go away, voting members, and 4 new ones come in. It's just like a changing of administration. They have different mindsets, different goals. Are they going to continue in line with what the Fed's been wanting to do as far as conservatively cut rates? Talked about 2 rate cuts in 2025. Are they going to change course? They're starting to talk. They have all their meetings and their presentations and things. So we'll be paying a lot of attention to what the Fed members are saying, especially the 4 new ones that are coming in. And then government debt. So the government has to sell debt. The Treasury Department pays the bills. The Federal Reserve sets policy. And the Treasury Department sells bonds, sells notes, so they can raise money to pay the U.S. debt, which is record numbers. And we've got $119 billion of debt being presented to the market this week to be purchased by investors. We got 3-year note or 10-year note, but the big one on Thursday is a 30-year bond. It's a bond auction. And people that buy those bonds also buy mortgage-backed securities because they're 30 years. They're really in the same the same animal, if you will. And so will there be a big appetite to buy these 30-year bonds? If more money flows into the bond market and people buy those 30-year bonds, that's going to be a good thing for mortgage rates, because when money flows into that bond market, mortgage rates go down. So we actually expect a volatile week. Are we at the bottom? We're sure going to see that. Will rates improve? Really, a lot of it depends on the bond market and what happens in that 30-year bond auction on Thursday. So low wage means less inflation. That'll be good. Weak jobs data means weaker economy. That'll be good for mortgage rates. Let's watch it closely. We're starting the week out floating. Have a great, productive week, a great first week of 2025, and I'll talk to you on Friday with our wrap up.